While most people are chasing the next meme coin, smart Australian investors are quietly building wealth through the power of ASX dividends. In 2026, with inflation still a factor, cash flow is king. Aussie powerhouses that aren't just paying. That's extra tax time benefits in your pocket. Let's dive in. This video is for informational purposes only and is not financial advice. Always do your own research or consult with a financial professional. Before the stocks, you need to understand why the ASX is a dividend gold mine. It's called franking credits. Because these companies already paid 30% corporate tax, the ATO gives you a credit for that tax already paid. It basically supercharges your yield. If a stock says 4% for many Aussies, it effectively feels like over 5.5% after that tax offset. It's the closest thing to a cheat code in finance. First up is the big one, Commonwealth Bank, ASX CBA. CBA is currently yielding around 3.5% to 4% fully franked. Now, you don't buy CBA for explosive growth. You buy it for the fortress balance sheet. They are the backbone of the Australian economy. In 2026, their ability to maintain high margins in a high-rate environment makes them a must-have for any defensive income portfolio. Next is BHP. Mining is the engine room of Australia, and BHP is the world leader. They've recently been yielding upwards of 3.4% to 4%, fully franked. With the global push for copper and iron ore for green energy infrastructure in 2026, BHP is sitting on the raw materials the world needs. Just remember, commodity stocks are more volatile, so treat this as your growth income hybrid. Number 3 is Wesfarmers. You know them from Bunnings, Kmart, and Officeworks. They are essentially a giant conglomerate that owns the shops every Aussie visits every weekend. They've shown incredible resilience, with recent yields forecasted around 3% fully franked. Bunnings alone is a cash flow machine that supports their dividend year after year. If you want pure stability, look at APA Group. They own the pipelines that transport half of Australia's natural gas. Because they operate as a utility, their income is incredibly predictable. They are currently boasting a massive yield of over 6.3%. If you're looking for a stock that acts more like a high-interest savings account on steroids, APA is a top contender for 2026. Finally, we have Telstra has completed its T25 transformation and is now a leaner, more profitable tech telco. Analysts are tipping a 4% to 4.5% yield for 2026. As 5G and data demand explode, Telstra's infrastructure becomes more valuable every day. It's a classic sleep-at-night dividend stock. The real wealth isn't just in the payout, it's in the dividend reinvestment plan, DRP. Instead of taking the cash, tell the company to buy you more shares automatically. This triggers compound interest, where your dividends start earning their own dividends. By the time you're ready to retire, that snowball will be unstoppable. Call to action, affiliate revenue. To start buying these, you need a broker with low fees. Pearler or Stake, because they handle all the tax reporting for the ATO automatically, which is a lifesaver.